Today on InvestTalk, we discuss how to battle against the massive rise in homeowners insurance costs. We then look at why the Chinese market sold off so heavily today. We also answer questions about Wells Fargo, IIPR, Civitas, and more. And at the end, I look at the final budget deficit for the US government in 2024.
This is InvestTalk, independent thinking, shared success.
Now, our main focus point for today is about homeowners insurance as a major hurricane barrels its way towards the west coast of Florida. Having protection for pretty much your most valuable asset, like your home, is more important than ever. And recent costs for insurance continue to go up. Homeowners insurance rates are up 37.8% cumulatively since 2019. So, there are multiple factors here. You have elevated home prices, inflation naturally. So it's what is the cost to replace the home if it is majorly damaged? So that's a big factor here. There's also industry consolidation, as well as a lot of insurers leaving markets entirely. Right, a lot of insurers have left Florida entirely, which allows those that stay to up their rates because there's just simply less competition. And so the industry is more consolidated. So there are ways to mitigate these increases, however. And the first and the simplest is home security, actually. Even the basics can save you a lot of money when it comes to home security. Think of smoke detectors, burglar alarms, deadbolts on your home, adding a sprinkler system, active fire monitoring, burglar alarm can save you a lot. The second would be installing new just updates to your home. Let's say a home improvement. So things like new roofs that are tougher to be damaged in a storm, that may be fire resistant, etc. That would likely generate a premium reduction. Also, features like storm shutters, upgrading plumbing and electrical. I think that's underrated, right? Because a lot of fires are started by poor electrical systems. So when you can upgrade that, get them up to code, there's a lot lower probability that will happen, and therefore you will see insurance savings. Then bundling with your home and umbrella policies. I think for those that have substantial amount of assets, umbrella policies can be important as well. Loyalty discounts, so staying with the same insurer for long periods, you can get discounts, but that doesn't mean you shouldn't shop around either. Going to a broker is not a bad thing if you don't want to do the work to kind of shop out exactly what you need, figure out exactly what type of coverage you need. Don't be afraid to do that, especially for these type of insurance products, things that can really tank your financial sustainability, safety. If there are major problems, I think insurance is fine in certain areas and actually needed in certain areas. The problem is a lot of insurers, they'll sell things like annuities or whole life policies, things like that, things that aren't really needed for a lot of people. So make sure you go into it with some level of understanding of generally what you will need, and then an agent can kind of curve or fit that to your particular needs and use their expertise to find you the most appropriate coverage for the best price. So don't be afraid to do that as well. There are also discounts for first-time home buyers that can happen as well, and newly constructed homes. Usually, newly constructed homes they have lower rates as well. So that's an overview right now of the insurance market. That is, prices are up, but you likely can still get insured. You just have to shop around for the best price. Now let's talk a bit about the market today. Now we were pretty busy with our webinar, but we were able to get some trades in the morning and follow the markets, and it was a pretty interesting day overall. The large cap growth side definitely did the best. You had Supermicro that was down 5%. Nvidia though was up 4%. Neo down 8%. We had the Chinese market certainly after that big surge. Had its biggest down day since that stimulus announcement, and it just goes to show you that. And it really, this is it's so interesting that people don't understand this quite yet about how markets quickly price in an expectation of what's going to happen, and often when that expectation is solidified, the market goes the other way. Buy the rumors, sell the news. And that's what happened here. There was an announcement from China in regard to the stimulus package. And it was pretty much in line with their initial announcement. And the market sold off on it because, they didn't build on that, right? And say, okay, we're going to do even more than that. And so, that was the step back in the Chinese market. And so a lot of the names that got a boost from the stimulus out of China we're down today, especially those commodity names, copper names, those were down. But what I say here is I think it shows a line in the sand. And that's why I think that you're going to continue to get stimulus out of China, is because if this doesn't work, you are still getting the signal from China that they need to do something. Now, this is their first shot across the bow. It's their first attempt to spark some animal spirits within the Chinese economy, Chinese stock market, etc. And we know that, especially look at our market, right, that the stock market is not the economy, especially if you're talking about certain subsectors or sub groups of the economy. Poor people, for example, right now are damaged by higher rates, whereas those that own homes here in the United States, they're actually benefiting from higher rates. Okay, so and higher inflation, and so it's pretty clear that China needs to find a way to stimulate the overall economy, and this is unlikely to be the catalyst for that. Because there's just not that connection from the stock market to that real economy. And so, does this mean that this China trade is over? Not necessarily. It's one day, but will we get follow through? Will we close below? That's what I'll be looking for. Are we going to close below today's lows? We closed well off the lows in something like an FXI, which is the Chinese large cap ETF. Are we going to close below that tomorrow or in subsequent days? I think that will be another signal whether or not this down move will hold. So that was kind of the big news out of markets today. Once again, overall, we remain in an uptrend. We're going to get choppiness. We're going to get choppiness into the election. Could be more volatility, and we'll watch for that. Now, really, the other big news is actually the MOVE index. This is the volatility of the Treasury market. That was up big. It recently bottomed around 90. Now we're up to about 123. Now, basically, when this gets above 150, and this is once again measuring the volatility in the bond market, when it's above 150, that is telling you that there are issues in the Treasury market when it comes to liquidity. And so the fact that the economic data has come in a bit better, that the Fed expectations for policy have been are becoming more hawkish over the past few days, because once again, the economy is doing decent. And so if that's the case, then you are going to continue to get a Fed that doesn't lower rates as aggressively and isn't as accommodative, and therefore the Treasury market could become an issue. And so I'll be watching this, and this was, I think, underreported because not a lot of people pay attention to it, but it could create some problems in the future.
Jeff in Tennessee was calling about Frontline PLC, symbol FRO. I bought this about 4 years ago, and it has done extremely well. I'm up over 200% on it, but the reviews are looking pretty bad. It looks okay to me. I thought I would get your take on it. It's only about 2% of my portfolio right now. If I should stay, that would be good, but I'd like to get your take. Thank you.
All right, looking at Frontline, and this is a company out of Bermuda, and they provide tanker transportation services for oil and oil products through 76 different vessels. And this is a name historically that has had a very, very up and down history of earnings. They're more of a price taker than a price maker, which typically means that depends on what's happening in the dynamics of the oil market. Now, global trade in oil still remains relatively robust. The demand for oil, global trade remains robust, and they are still continuing to do well over the past few years, Earnings this year are supposed to be $3 per share from $2.63 last year, but they lost money in 2021. 2019, they made 82 cents. So clearly they're doing much better. And, the trends is fine. It's in an uptrend. It weakened recently. But overall, I don't really see an issue with it. I would continue to hold it. Earnings are supposed to reaccelerate next year. So they're up 11% to 334 next year. So based on forward-looking earnings, you still have a high single-digit multiple. They have a decent balance sheet. It's still high risk, $5.6 billion market cap, so right in that mid-cap space. But the trends are still positive. Demand trends for oil remain positive. And so I would hold on to Frontline. Thanks for the call. Let's get to a quick question submitted via the comment section on our YouTube channel. I can't say the username, but it says, what age do you have to take RMDs, and will the broker notify us? Your broker typically does not notify you. We do as advisors. We have a RMD dashboard within our Orion platform, and we can notify our clients. Now, your broker will tell you how much it is based on what they know your IRA value would be at the end of last year. But it's up to you to take your RMDs. Now, RMD age has moved to 73, but over time it's likely to move. It's going to move to 25 based on the Secure Act 2.0. And once again, that's if you. Oh, that's in 2033. Excuse me. So it's 73 right now, and in 2033 it will move to 75. So it depends on your age. Now let's pivot back to the InvestTalk voice bank. You know the number. It's 888-99-CHART.
Hey guys, love to get your thought on ticker symbol WFC, Wells Fargo. Looking to hold it for long term. So it pays a decent dividend. Thanks. Have a good day.
All right. Well, Wells Fargo, we know they had their issues with the fake accounts, and they were fined, and they had a lot of internal problems there. And it's recovered. It's doing much better now. It made $5.16 last year, so let's make $5.07 this year, down 2%, up 6% next year in earnings. So kind of very low growth here, but it's trading in the low teens and multiple, so it makes sense. Now, it's a large bank, so it's definitely one of those. It's not a regional bank, right? So it's one of those ones that, because of its size, it can handle the regulatory issues that are likely to arise with a lot of those smaller banks. So I think Wells Fargo has a leg up there, but if you compare it to a lot of the other large banks, I think it kind of underwhelms. And it pays a dividend, 2.8%. But like I always say, dividends are overrated. It's all about the quality of the business. And frankly, Wells Fargo, it's not a bad business. It's just not really the best within the banking sector. So I would just look elsewhere, to be frank. I think you're going to get a much better return on equity, return on invested capital with some of the other large banks. You're looking in the right arena, but this is probably not the one I would be picking up. Okay.
I'm a new listener. I'm actually trying to be a new investor. I've been trying to get information, and I'm pretty sure you've probably tackled this before, but I would be grateful if you could just, again, talk to a new investor, just a couple of highlights on what we need to do. I know for sure that I've been advised, make sure you've covered your dates. You don't have any major outstanding loans, which I've managed to do. You have an emergency fund on the side, which I'm building. I've had somewhere that it should be about $3,000 minimum, or at least 3 to 6 months of your salary. Anyway, I am building that. So I was thinking of getting to the actual investing. I would appreciate any tips or ideas on, what steps to follow, what to look out for. I need to be looking out for as I actually get into the actual investing process. Thank you very much.
All right. This is a great question. Congratulations on getting rid of debt. Now you're into the investment game. Now you're early on. The first piece of advice would be patient. Don't rush into anything. Understand what you own. And you really need to make sure that you have a full grasp of terminology, keep listening to things like InvestTalk, reading as much as you can, etc. So education is job number one. It looks like you're starting that. Then you need to figure out, you need to answer a few questions about what you're going to do with this money. So first is time horizon. You have to match the time horizon with volatility. So if you're going to need the money in the next couple of years, you want assets with low volatility. Okay. And the further you go out, the more volatility you can stomach. And then you need to be honest with yourself about your risk tolerance level. Now, we do it with a risk questionnaire on our website, so anyone can go over there and take that. And that's to help understand what type of investments you should own. So, for example, our scale is 1 to 99. The S&P is 80 on the risk scale, 80. So if that score comes in at 26, well, that means you probably shouldn't be in much equities at all, right? But if it comes in at 90, 95, anywhere kind of north of 75, you can definitely take, a good amount of risk and buy all equities. So understand your risk tolerance level. The third would be, what vehicle are you going to choose? You could buy an individual stock, or you can use a fund, right? Individual securities or a fund. So with an individual security, there's more upside, but there's more downside. You can create a more targeted portfolio, but it takes more work. And you have to do fundamental and technical analysis. For new investors, that typically is very difficult. That's why I say you probably want to default to funds of some type. Now you get instant diversity because those funds own dozens, if not hundreds of different positions in that fund, but you're paying a fee there. There's some sort of fee level that you need to account for. Much less work, but you don't learn a whole lot. That's one thing I love about individual stocks is you actually learn when you own them. You see kind of the idiosyncrasies of different companies, different sectors, et cetera, and you absorb a lot. Whereas funds, they're just so diversified, you don't really get a feel for what's happening in each individual name. So probably for the broad swath, you want to go with funds for now, and maybe buy individual securities here and there as a small percentage of your portfolio if you want to continue to learn. And then the best tip probably would be, don't take tips from your average person, your cousin, your neighbor, your brother, some guy in your local, your local bar or your fantasy football league or something. Those tips don't rarely work. When you hear about them, you're probably late to the game and you don't understand the risk that you're taking. And you have to make sure you do your own research. So that's kind of the end there. It's do your own research every single time. Okay. Thanks for the call and congratulations on being a new investor. Now let's talk a bit about the dollar. The dollar. This is so important because I get hyperbolic statements all the time about how there's the dollar demise and the petrodollar system is coming undone, and that means the dollar is going to go into some spiral. Well, the petrodollar system is coming undone to a degree, but the dollar remains relatively strong. From the dollar was up about 5% through the end of July. Then it started to weaken recently, and up until the Fed rate cut, and then the dollar started to appreciate again since that Fed cut. So it's been a choppy period for the dollar, but certainly not a demise in any sense of the word. Now, the dollar's current valuation already reflects the path forward for rates. Remember, the market prices in rate expectations. So one of the reasons why the dollar started to rally recently is because the market expectations of 200 plus basis points of cuts between now and the end of next year has fallen back to about 150 basis points of cuts, roughly. Okay, and so that is starting to be priced back into markets, and you get a bit of strength in the dollar. And so that's the number one thing you have to understand is markets are pricing these events in, and that's why the 10-year is now back above the 4% mark. Now, there are other factors that must be considered when you look at foreign currencies, things like cross-border trade, capital flows, and that's been a big factor here, is capital flows into U.S. assets, mainly U.S. equities. And for the dollar to weaken, a lot of those foreign owners of our equities need to sell and move abroad. The problem is that there's just not a lot of opportunity abroad. And you look at the relative strength of our economy, the attractiveness of our bond yields, right? Just money going into treasuries, which typically are right now, even with the rate cut, higher rate than you're getting in a lot of major developed markets like Europe. And then you have technology, right? The AI craze. It's not just the average U.S. investor that's trying to invest in AI stocks. It's a lot of foreign investors as well. And so there would need to be a catalyst for growth overseas to bring assets, repatriate them out of dollars and back into other currencies. Now that has pushed the valuation on the S&P up to 24 times forward-looking earnings. The longer-term 10-year average is 18. So, yes, stocks are a bit elevated, especially those mega cap names. And so, but valuation in and of itself is not enough in order to create these flow trends. Okay, it's going to need a catalyst of some kind. Now, I will say it's set up for the potential for money to flow out of the U.S. economy. The economy gets weak enough, which right now it still seems like a soft landing. You would need a hard landing probably for the for investors to pull money out of the U.S. But paradoxically, a weaker dollar would be good for the overall economy. And so that's what's interesting here is it's hard to see a real precipitous decline in the dollar, because if the dollar does get weak for a period of time, that will actually help the U.S. economy, which would flow money back into dollars overseas. So, that's why the dollar isn't really getting that strong downside move, because there's so many factors that are requiring dollars, including, and what's mostly underappreciated, drastically underappreciated by the average person, are foreign denominated debts. Think of your mortgage. What do you pay your mortgage in? Do you pay it in the Mexican peso? Do you pay it in the Canadian loonie? Do you pay it in the British pound? No, you pay it in US dollars. And so what happens with a lot of debt around the world, the vast majority of debt around the world is denominated in dollars. And those people that need to pay those debts, or entities that need to pay those debts, they need to take their assets, whether that's a foreign currency, a foreign stock, commodity, whatever that is, and they need to translate that into dollars. They need to go and buy dollars with those assets and repay those debts. And you're talking tens, if not hundreds of trillions of dollars of debt outstanding in US dollar denominated currencies. So that's so underappreciated, drastically underappreciated. So many people talk about the petrodollar and the petrodollar is coming undone, and that's going to mean the dollar is going to crash. No, that's not how this works here. Okay, it's multifaceted. There's a lot of variables that play in here, and so when you're thinking about the worst case for the dollar as we head into next year, it actually might be the best case for a global economy. Once again, the dollar weakens, that is actually good for the overall global economy. Let me state that one more time. If the dollar weakens, that is good for the overall global economy. So there's a lot of doom and gloomers out there that try to they see things in their own lens, right? They wish for a crash, or they're hoping for a crash. They want to be right. And they line that up with a crash in the dollar, and it just does not line up. You can't have one or the other. Or you can't have one with the other, right? They're actually inversely correlated here. So I wanted to hit on that because it's so vital to understand those flow dynamics. Now let's dip back into the InvestTalk voice bank for a question that came in earlier from a listener in Atlanta.
Hey, Justin or Luke, this is Jason from Atlanta. I was calling about Centrus Energy, ticker LEU. With all the talk about nuclear energy and all the clean power that we're going to need going forward, I thought I'd take a position in this one. I wanted to get your opinion and see what you guys thought of it. All right, thanks. I'll listen to it on the show.
All right, looking at Centrus Energy, LEU is a symbol. They supply low enriched uranium for commercial nuclear power plants. And it's near a 52-week high. Let's see. I'm going to do a chart here. Yeah, it's right at a 52-week high, down from actually reversal yesterday. Yeah, down from a couple days ago. But it's hanging around there, and it's interesting because earnings are expected to be $3.06 this year, down 44% from $5.44 last year. And it's supposed to be $2.92 next year. That's not great, right? That earnings trajectory is not great. Now, the good thing is they have a good balance sheet, okay? But free cash flow is only $3 million on about $1 billion enterprise value. That's very, very low. I don't like that. Its shares outstanding, 16 million shares, and that continues to go up. So, my issue here is that's just all over the board. It's too all over the board. And I like the arena you're looking at, but, I just would not touch this. I just don't like the longer term prospects, past prospects of the business, and future earnings are again down 44% this year and 5% next year. They're just better opportunities within the nuclear space. I like betting on nuclear. This is just not the horse to ride. So I'm passing on it.
Long-time listener, just curious your opinion on ticker IIPR. I'm looking to add some additional REIT exposure to my portfolio, and I've had my eye on this for quite a while, nearly a year. I've been watching it, and just curious what you think at these levels. Look forward to hearing it on the podcast. Thanks again. Bye.
All right, looking at IIPR, Innovative Industrial Properties Incorporated. It is a REIT, Real Estate Investment Trust. We've actually owned this for a long period of time. It was trading back in the middle of last year in the mid 60s, and now we're up to $129 per share. And in addition, it has a dividend yield of 5.87%. Now, the first thing you have to remember, this is a REIT. So that dividend, if it's in a taxable account, is going to be taxed at your ordinary income tax rate. So first off, understand that. Now, it's in a strong uptrend. Relative strength is 92. It's why one of the reasons we love it. It just continues to make a series of higher highs and higher lows. You have that dividend you're getting paid, has a very strong balance sheet, but it is in the cannabis space, medical cannabis properties. So you're talking about, grow facilities, you're talking about dispensaries, et cetera. And, their value add is they're able to get those properties permitted. And that means they're able to extract higher rents because of the fact that they are legal facilities where there's a lot in an industry, there's a lot of regulation. And so we still like innovative industrial properties, and we continue to own it. Let's go take another question submitted via our comment section on our YouTube channel. And AD-7 says, CIVI, too cheap not to buy. I've been nibbling but took out a large position last week. Dividend looks a little high. Is it sustainable? I love this question because it's so important to understand where the dividend comes from. Now, we do own Civitas. This is CIVI, C-I-V-I, for clients. So we like the company. But we also are eyes wide open to the fact that that dividend will fluctuate. They say it in their earnings statement. So yes, it says dividend yield 11%. They will not pay out 11% going forward. That dividend will fluctuate lower based on earnings. Okay. And so it's extremely important to understand. This is why you can't just look at a dividend yield and say, hey, this is the dividend I'm going to get. Because dividend policy can change. Dividend policy isn't the same from one company to another. Now, they do have a policy to return capital to shareholders, partially through a dividend, partially through stock buybacks. But you have to know that. You can't just look at the actual dividend and think that's what you're going to get, okay? So make sure you have your eyes wide open to the source of that dividend and whether they have promised to kind of keep that dividend in place or not. Civitas dividend will fluctuate. Do not buy it for the dividend. You want to buy it for a rebound in oil prices and the quality of their assets, which we do continue to like. Thanks for the call. And lastly, let's talk about the budget deficit. The fiscal fourth quarter is behind us when it comes to the U.S. fiscal situation. It ends the third quarter. And the report from the Congressional Budget Office is that our deficit was $1.8 trillion in the last fiscal year. Collected nearly $5 trillion in revenue, but paid out over $6.75 trillion in spending, putting the total deficit to $1.83 trillion for the year. Now, the deficit last year was $1.7 trillion. Now, you would say, oh, well, it's gone up. Well, not really. There was a $300 billion kind of adjustment due to the reversal of student debt cancellation, et cetera. So if you adjust for that, actually the deficit was a bit smaller, 4%. It was a bit smaller than last year. Overall, the deficit was 4% smaller than the CBO projections in June. Okay, so slightly better. If you think of the revenue from corporations, you have corporate tax deadline in September. And so there's a lot of collection there because companies are making good money. Now, when it comes to spending, the largest federal entitlement program, Social Security and Medicare, cost 6% more than they did in fiscal 2023. But we spent $950 billion on interest. That's up 34% from the prior year because of higher interest rates. And now interest costs are higher than military spending. Revenue climbed 11% on the year. And a lot of this, though, was driven because of a delay in tax payments because of natural disasters here in California. There was also a pause. The IRS paused payments of the employee retention tax credit. And so that was pushed into the previous or into this year. So that 11% was a bit higher than reality. But overall, the deficit is at 6.4% of GDP, which is, it's kind of too high, especially if you consider this is not really wartime. It's not in a crisis period. Unemployment rate is very low. And so, we're still on a tough fiscal trajectory. Maybe not as dire as everyone says it is, but it definitely is not on the right path. And both policymakers in both parties, they don't really have a path forward. They both disagree on how aggressively they need to address this problem. But both sides don't want to touch the biggest part of our spending, which is Social Security and Medicare. Now, luckily, healthcare costs are growing slower than expected, but still, this is the largest part of the budget. And until that is addressed, I don't think we'll get on any good fiscal ground going forward. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. And be sure to rate and review on iTunes as well. And head over to our YouTube channel and subscribe as well. Remember, that's InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Good night.